Hi, here is Richard Koza from SimpleStockTrading.com, and I'm here with a video describing one technique how to manage stops during a huge gap. A gap occurs when an opening price is much different than closing price from previous day. This situation happens on the stock market from time to time. You can find individual stocks gapping up or down, or you can find a situation when the market mood is generally changing and is so strong that is pushing a lot of stocks to gap down or gap up. In this video I will speak about gap down, but generally the same technique can be used also for gap up, just in opposite direction. So as I mentioned, when this situation happens, you often find that your stop loss is not possible to apply because an opening price is well below this stop loss. And here I would like to give you a first recommendation for this situation, but not only for this situation. It's general recommendation I use as a rule for every my trade, and it is: do not enter stop loss order when stock market is closed. So don't put and don't activate your stop loss order before the market is before market open or after the market close. This if your stop loss order is put before the market is open, then you will face terrible situation during such huge gap day, and I will show you on the charts later what you can expect. So the key is: do not enter any stop loss order before market open. Yes. And the second rule for managing stops during gaps days is that you have to manage your trailing stops actively. Yes, so you have manage your trailing stop order during the day of the gap. I will show you how to do it, and this is very important because when such gap day occur, then your trade is mostly is going to be closed on a worse price than you expected. So by managing your trailing stop during this gap day, you can make your exit, you can arrange your exit at much better price, and that means that you can have more profit if it was already profitable trade, or much smaller loss. And it is very important for your profit and loss for not only for the single trade, but this plays a role also for your monthly P&L or quarterly P&L. So what you can expect when you see this these gaps. So I would like to open two charts, and here you can see, for example, a chart of SPY as it made two gaps, and I will speak about this second one, which was really huge, and this gap occurred on August 24th, 2015. SPY, which is ETF tracking S&P 500 index, closed previous day at 197.83, and next day the opening price was 187.33, so 10-point gap down, and it is significant. It is significant gap down. So how to manage situation when the opening price is such different? So I would like to show you this my technique. So here is an intraday chart of SPY during this gap day. It is 5-minute candlestick chart, so you can set these candlesticks for 5 minutes, and it's really important to use intraday real-time charts available for managing such a situation. Otherwise you cannot manage it properly. So what I do during such days, I never place a stop loss before the market open or right at the market open. Never. Why? Because as you can see, first look at this first candlestick. Your stop loss order, even you have trigger price, let's say 196 or 195, were executed at the much worse price, about 186 or 185, or maybe near the lows 183. So my tactic is to wait for end of first 5 minutes and put my stop loss right below the 5-minute low. Why I do it? When such huge gap occurs, then most of inexperienced traders or investors put their stop losses before the market open, and they are executed during these first 5 or 10 minutes, and that's why I do not trade, or I do not want to make any trade during this 5 minutes, because during this 5 or 10 minutes there is huge selling pressure. But very often price rebound from this level after this initial selling and offer me or you as a trader an opportunity to manage your trade and close the trade at much better price. So I use 5-minute low as a first trigger price, but you of course can set 10 minutes. It is probably the same. You can use also 10 minutes candlesticks, but 5 minutes are quite fine. So when the bounce from this 5-minute low happens, then I wait, or you have to wait for this already your stop loss in the place, and now you wait what is going to happen, and you are going to use a typical trailing stop tactic based on higher lows and higher highs. So now we wait for a higher high, which is here, and then for higher low, which happened here, and immediately as the stock made a higher high again, I moved my stop loss here. And see, we have already our stop loss from 183 to 180, let's say 8, which is 5 points better. Now I wait for new higher high. Nothing happened here, but it happened here. So I moved my stop loss right here. I can make it longer to show you. Then here is higher high, again correction, again higher high. So there are two possibilities. You can find two possibilities: to place stop loss here, or to place stop loss immediately here. As we approach midday doldrums, it's possible to make your stop loss much closer to actual price. And as you can see, your stop loss were triggered near 194.50 or similar price. Yeah, so 193.5. 193.45, sorry. So using this simple technique, you are able to manage your stop loss from 183 to 193. So it is 10-point improvement, and it can be very significant amount of money in your trade. You can of course use this technique on single stock. I can show you something like this, and this is BLDR stock. Again, this stock gapped with sympathy with sympathy of the stock market. The stock gapped down the same. Maybe your stop were somewhere here, and now you are well below it. So again, 5 or 10 minutes low is here. I wait for a higher high, which happened here. I can place my stop loss here, and again wait for higher high that happened here. I can move my stop loss to this place. Again, here you can see new higher high. I can immediately move my stop loss to this level. This is small consolidation and new higher high, so I can move my stop loss here. And as you can see, we are almost on the same level like here, so 14.6 from, let's say, 12.9, and it is almost 1.5 improvement in stock. In such price stock, it is 10% almost. So we were able to manage price improvement about 10% from the initial selling. So, and finally we probably are triggered here, not very far from our former stop loss level. So you can see this technique is really helpful, as when such huge gap happens, then very often you can see some form of intraday bounce. Yeah, sometimes stock will continue till the close to new highs, so you can trail till close, and then decide whether to close by the trade by the end of the day, or keep position for the next day. All this this decision should be made in accordance to global market mood and situation. In this case, as you can see, the global market were in huge sell-off and almost in panic mode. So I would prefer to exit position during the day on the trailing stop, or if my trailing stop were not hit, I will close it at the end of the trading day. So what you can take from you should take from this method: first, do not place any stop loss order before the market open, not only during gap days but generally. I prefer to place my stop loss order generally after 10 or 15 minutes of trading, and during the huge gap day you have to manage your stop, your trailing stop during the day, and it can help you to save a lot of money or make more money from such a trade. So this was a video about how to manage stops during gaps. If you have any questions regarding this technique, please let me know. You can do it by commenting this video, or by sending me a message through a contact form on my page, simplestocktrading.com, or on my membership site, private.simplestocktrading.com, or you can send me an email, of course, anytime. Thank you for seeing this video, and see you next time. Bye bye.